My name is Marie Conser. I'm a real estate broker in Oregon. And in today's episode, we are going to look back at 2020 from a real estate standpoint and look forward into 2021. Let's start looking at this year in review. And I know 2020 has been a painful year for a lot of people, and some are still feeling the effects of the pandemic and the wildfires. I mean, we had so much going on. I'm thinking of you all, and it seems like those elements have had a very short effect on the real estate market, but it has recovered since. So let's take a quick peek here at what it looked like back in December at the recovery index. There are four components in this index: demand, which is very strong; supply, which is very low; the prices that have been pushed up by the supply and demand; and the time of on market that have shrunk because we have high demand and low supply. So you can see at the very beginning of the year here in March how the market slowed down tremendously due to COVID, due to the pandemic. And then it has now more than recovered um, in December, November, December, more than recovered. We had a quick pause during election week. It came back right away. The activity resumed very quickly afterwards. And one of the things on everybody's mind has been the mortgage forbearance. A lot of people, due to the pandemic, lost their jobs. A lot of mortgages went into active forbearance at the very onset of the pandemic. And a lot of rumors are floating around that there will be a wave of foreclosure. Well, the good news is that the number of mortgages in active forbearance has decreased dramatically. You can see that at the very beginning of the pandemic, we had close to 5 million mortgages in active forbearance. And at the end of November, we sat below 3 million. So that's still a lot of mortgages. That's still a lot of people suffering. But it's definitely a lot less than what we saw at the beginning. And what's been happening is upon exiting the forbearance plan, the majority of people actually are faring pretty well. We had 7.1% of loan paid off. 30% of people, close to 31%, actually continued to make their monthly payments during the forbearance period. And 17% brought their account back up to current. So more than half are paid in full, meaning paid up. About 30% of them are working out through a repayment plan, whether through a loan deferral or a loan modification, but they are actively working with their servicer to get back on track. We still have some people in trouble, but it turned out to be a smaller amount than what some people were thinking could happen. So that's the better news. Again, we still have people suffering through the aftermath of the pandemic and are still trying to play catch up here. Now, we talked about the fact that the low supply and the high demand are pushing the prices up. And some people are wondering if the prices are going up too fast. Well, if we look back historically at the data, since 1991, 3.8% was the annual house price appreciation rate. Since 2012, that house price appreciation rate has actually increased to 6.1%. So let's take a look at if we had kept that 3.8% historic appreciation, this is what the curve would have looked like in thousands. All right. Let's apply what has been truly happening, the actual appreciation against this projection. This is the housing bubble right here, where the prices were pushed up because of a lot of it was due to access to credit that was very easy. The housing bubble burst, and it was felt through a falling house price appreciation. But it has been coming back up since 2013 pretty steadily. And in this year, we actually exceeded the historic appreciation of 3.8%. So we are not only back on track, but we're actually exceeding the expectations that were placed with that historic appreciation of 3.8%. Now, this is all driven by the inventory. We simply do not have enough homes for sale. So the spike in inventory here, which led to a lower price appreciation, home prices, that is the aftermath of the housing bubble burst. All right. But since then, the inventory has continued to decrease, and we're seeing those prices increasing. As the inventory goes down, the prices go up, and so on. There is a direct correlation with the supply. So that is the reason why it is not 2006 again. I have constantly clients asking me, or prospective buyers asking me, are we in a bubble? Or I will hit pause and wait until the bubble bursts. It's not bursting. And the prices will continue to appreciate until we have enough supply to meet the demand. Or the demand goes away, but I don't see that happening at this point. The demand is way too high. So back in 2006, we had adjustable rate mortgages. We had 100% financing. And that is not the case today. People come with, even if it's a small amount, they come to the table with a down payment. They're using fixed rates. I mean, what's not to like? They're very low. We'll talk about that in a minute. But the main difference is that 14 years ago, we had 3.8 million homes listed for sale. And the builders were putting up about 2 million new units. Today, it's 1.5 million homes for sale. I mean, it's less than half than what we had 14 years ago. And that is what we're feeling through this market. Now, there are some headlines that are grabbing people's attention and are making them nervous. Again, a wave of foreclosure, or a wave of issues with the fact that there are a lot of mortgage debts. There is a lot of mortgage debt. Let's take a look at mortgage balances in a different way. Mortgage balances have always been the largest component of household debt. All right. And we have reached some very high volumes, like the Federal Reserve Bank here statement that says as of September 30th, this was the second highest volume in the history of the series, and second only to the historic refinance boom in 2003, third quarter of 2003. Let's flip it around and look at the mortgage as a percentage of disposable personal income. You can see that in 2007, when the housing bubble was going on, it was 7.21% of the disposable personal income. Today, it's set at 3.72%. It's a completely different picture, absolutely completely different picture. So let's see what might happen in the future. All right, the first thing is the pandemic. Unfortunately, we're still in the middle of it, and there is still a lot of unknown about when this is going to end. What we know is that it's going to continue to affect jobs, but it also continues to create shifts from services to good and from in-office to remote work. So we have yet to see what those small shifts in these trends, how they're going to change how businesses are hiring, how job seekers are searching for jobs, where people are going to live, and how much they earn. I can tell you that we have seen a trend, for example, here locally from downtown to the suburbs, because people were seeking that outdoor space that they do not have in condominiums. But that's one of the multiple effects. Now, mortgage rates in 2021 are forecasted to stay around 3%. And actually, there are rumors that they can extend even further. There will be another video here with a lender to talk about that. We went quite down in 2020. I don't think we're going to see kind of those low rates in 2021, but it will definitely stay low. Now, in terms of price appreciation, we still have to contend this year with high demand and low supply. So it's going to continue to be a very strong activity, probably in terms of home sales, 7% more than in 2020 for 2021. The seasonality will probably remain the same with more homes coming on the market in the spring. But that will definitely continue to push prices. So we have a 12-month forecast on the left, a 2021 forecast on the right, both from analysts and real estate professionals and lenders. And they're all predicting home prices to continue to go up between about 2% up to 6% for next year. So we'll see what is going to come. But on average, for our region, it was close to 7%, but I'll show that to you in a minute. Now, with all of this, any foreclosure increases that may occur will be absorbed by the market because, again, of the lack of supply. So there is no expectations from the chief economist at the National Association of Realtors, Lawrence Yun, to see any price declines caused by foreclosures. And this winter, frankly, is going to be one of the best winters for sales activities. It was already a banner year for all the real estate professionals, from realtors to lenders to escrow officers, et cetera, last year due to the volume of activity. It's expected to be very similar in 2021. Now let's take a look at our local market. I want to dive more into here, Washington County, mostly West Side. The first quarter, very high level of sales activity. We started the year very strong, and March, April came in with a pandemic and the stay home, stay safe order from the governor that paused a lot of things. Now in May, the number of buyers increased because COVID started to become, we started understanding how to manage that, do safe showings, practice safe, showings, basically. So the buyers went back, but the sellers kept their home off the market. And I understand that they wanted to stay home and not having anybody bother them. Well, that created a sold out situation. Basically, all the homes that were on the market virtually sold out. In June, with the summer approaching, there has been a lot of sell activity driven by lifestyle destination and surrounding markets, were very attractive and again became virtually sold out. The summer, fall, basically everything was, every listing got multiple offers. It was bidding wars left and right with price appreciation. So it's going to be interesting to see that looking toward 2021, that cyclone of activity that we have seen is going to remain strong, driven by low interest rates and low inventory. Numbers, let's talk data for a second here. You can see on the left-hand side for last 3 years, basically 2018, 2019, 2020, we'll have December number very soon here. But basically this is the inventory expressed in month, and 4 to 6 months of inventory is a balanced market. So we've been at 3.3 in January 2019. Everything else has been below and record levels of low inventory in 2020. By the way, 1.2, we had this happen only once back in, I want to say it was 2005, I think. But anyways, don't quote me on this. It happened once before. And this happened in July. And then look at this, September, October, November, and I expect December to be at 1 or below 1, actually. And this has an effect on the prices, because average sale price has increased 6.9% in the last 12 months and 6.5% increase for the median sale price, definitely pushing prices up. Now, I was telling you that we had started 2020 with a very, very strong activity. This is comparing that week with the week from the previous year in 2019. And you can tell we had started between 20 and 30% more activity in the first 2 months of 2020 than in 2019. And then COVID started, and then we got minus 43% here. That was the week of the stay home, stay safe, minus 22, minus 43, minus 33%. And then the buyers went back out and we resumed our activity. And after a little hesitancy, we started in double digit again, more activity, 25% more here, 37% more there, 45% more in July. I mean, it has been a very busy year compared to 2019. And the numbers just show it. It's just data. It's just data. Now, per price point, this is what we're looking at. So we are in extreme shortage between $250 and $750. We have a severe shortage up to $1 million and below $250. Okay, there's virtually nothing basically under $250. It is a very, very, very low supply of homes. Above $1 million, it's a very healthy market, but you can see how we have, for example, between 350 and 500, we had 135 new listing coming in December. And in December, we actually recorded 160 homes going under contract. So we are in a sold out environment. That's what that means basically. And the interest rates being so low are definitely providing fuel to the situation. Now, 2021, let's look forward. We'll see a surge of buyers, that's for sure. That cyclone I was showing you will continue. We will continue to remain sold out in 2020. We need homes for sale. What I know is that some sellers, are very hesitant to sell in this market because they're not sure they will find a home to buy. I have a strategy for that, working hand in hand with a lender. Stay tuned for that video coming up this week. But the bottom line is interest rates will remain low. The inventory will remain somewhat low. The demand will continue to be strong and the prices will appreciate accordingly. I want to finish on where are those buyers coming from? part of those buyers are people buying their first home, what we call the millennials. They are buying their first home. They have a steady job and they are looking to invest. But the other thing is we have a lot of people moving to Oregon, and some states are really suffering from the loss of a lot of individuals. And Oregon is one of the beneficiaries of this migration. So this is a quick snapshot here through 2018, but basically most of the people continues to remain true, from California, from New York, Illinois, Michigan, Colorado. And we do lose population. We do lose to Washington for tax purposes, Idaho and Arizona. So overall, Oregon is on a gaining plan, if you want, and it has been the case for a long time, and it's expected to remain the same here for the foreseeable future. So this is it, folks, and this is the year in review and a view into 2021. Let's see what happens, and if I can help you with your real estate goals, or if you have questions about how to get to your real estate goals this year, please reach out to me and we can have a free, private, confidential conversation about how to make it happen. Thank you so much and have a great year. Bye-bye.